shares in EasyJet plunged 10% following Thursday's announcement. Let's get more on this with Susanna Streeter. She's Senior Investment and Markets Analyst at Hargreaves Lansdown. Always good to see you, Susanna. Now, look, EasyJet's being coy about the takeover bid that's gone away, although the markets have their own ideas. I mean, the airlines have taken these steps to shore up its finances and said it isn't just for COVID stuff, but to help them grow. But might EasyJet get swallowed up by a competitor before it can partner up with anyone else?
There is a chance, of course, because of the pandemic effect, it is likely that we will see more consolidation in the airline industry, but whether or not EasyJet will be swallowed up or make perhaps a bit of its own, we'll just have to see. Now, there was intense speculation that it was a rival, Wizz Air, that came forward with this unsolicited offer, and as you say, they were rebuffed, and instead EasyJet has launched this rights issue, wanting to raise 1.2 billion from shareholders to help see it through the crisis, and also, as you say, potentially make changes to shore it up for future growth. That may include perhaps increasing the number of routes that it flies, because certainly its rivals have been doing that, Wizz Air and Ryanair. We'll have to see exactly how that money is spent, but there's without a doubt EasyJet has been going through a very tough time.
In which case, the only way is up. But look, there's been a lot of interest in UK companies at the moment. Morrison's, the supermarket, for one. So let's talk about them in the news today, because they're saying things are going to get more expensive with the UK's lorry driver shortage. But how much of a worry is that?
Well, yes, there was already some disappointment given the fact that actually their profits fell by 37%. There had been hopes that the worst of the COVID costs would be behind it. Not at all, really. And certainly in this first half, those costs really weighed heavily on the company, as did, of course, losses from the fact that it hasn't been able to open cafes in store, and fuel sales were very low as well. But now there is another challenge on the horizon. In fact, the supermarket chain, like many others, is already dealing with it. We're talking labour shortages, particularly the HGV driver crisis. But also there are bottlenecks throughout the supply chain, as we've been hearing. Wholesalers are saying that actually food prices are going to have to rise. And Morrison's has a very large wholesale business as well. So although for now much of the costs have been absorbed without passing on to customers, it's likely that prices will have to rise. And of course, when there's such competition for shoppers at the moment, that could make it more difficult for Morrison's at the time when, of course, there are private equity giants swooping on the company. I think Morrison's is going to want to get this kind of deal signed, sealed and delivered very soon before any of these supply chain issues become really large.
And they're going to want to make themselves look as good as possible. Let's talk about China's property giant Evergrande. I mean, they're riddled with debt, it's downgrades, shares tumbling. I mean, investors fear this could be catching, don't they?
Yeah, there is real fears of contagion. There are reports that, in fact, another Chinese property group, Fantasia, might be running into problems as well, with reports that actually its bonds aren't being accepted by a number of banks. Now, this is all speculation so far. There hasn't actually been confirmation of this, but certainly what's been happening at Evergrande really has sent jitters through the market. Shares have slumped again after 2 credit downgrades in as many days, amid concerns that it will default on parts of its massive $300 billion debt pile. And this is all because of changes within the Chinese property market. Prices have slumped around 20%. And really, although, of course, Evergrande could sell assets, are there going to be enough buyers out there, with prices almost looking they are in free fall in some areas? So real worries about the possible spread of this crisis elsewhere.
What are investors looking for? I mean, if we look at European markets, you know, they've been flirting with 6-week lows after a really strong start to the week and a good run of things. They've got an eye on the data. All this data coming out rather weak, not surprising. So what do investors want?
Well, it's really difficult at the moment because there are 2 things going on. There is this economic recovery, of course, and we heard from the European Central Bank today that actually that recovery was pretty strong, and we've seen inflation rising as well. Now, That is good news, of course, in terms of the pandemic recovery, but then it also means that the European Central Bank is going to start recalibrating its massive bond buying programme. And given that the financial markets are pretty much hooked on this drug of cheap money, that will concern some as well, although, of course, it's not going so far as perhaps the US Central Bank, the Federal Reserve, and the Bank of England, who are likely to start tapering their bond buying programmes. But in addition to this, there is this fear, of course, of inflation with all these supply chain issues lingering. So on one hand, we want to see economic growth and this rebound, but we don't want to see inflation running out of control. And that's the tricky situation central bankers have to try and deal with right now.
So inflation and tapering, those are the two words of the financial month. Thanks very much, Susanna Streeter.
Well, as we heard from Susanna there, the European Central Bank has announced it will put the brakes on the wave of stimulus measures it unleashed in response to the COVID crisis, becoming the first of the world's big three central banks to do so. Let's talk to Ryan Thompson in Frankfurt. So, Ryan, the ECB says it's recalibrating rather than tapering. So what does this mean? Decode it for us, please.